Hello, good morning. It's a real pleasure to be invited to this conference, and I'm particularly thankful to Dr. Ahmed Dalal and Abdul Latif Al-Hamad. I'm also very happy to have Sheikh Mohammed in the audience, who sits on the board of trustees of the center. I'm based at Oxford. So it's a real pleasure to be here. Let me set out a few things before I begin. The presentation today is based on a rather extensive paper, about 40-page paper, which is part of the ERF project. And it's, in a sense, it's a survey paper. It looks at a lot of themes and is rather ambitious in the sense that you have a huge domain to cover: fiscal, monetary, exchange rate, policy arrangements. And so by virtue of its breadth, I would argue that many of the themes raised are really plausible hypotheses, which could be later on empirically verifiable claims. But I'm basically raising issues before the audience, and these are basic hypotheses. The other clarification I would like to make is that I have lots of graphs and charts, but I'm not presenting them here. I'm basically assuming that we know some of the underlying patterns of fiscal policy, monetary policy arrangements, and we are more interested in what Dr. Jalal mentioned, the underlying political logic behind the institutions and the outcomes. Now I have about, I think, 35 minutes or so, so maybe you give me a 5-minute notice when I need to end. The slides, again, are quite extensive, and I'm hoping that we would circulate these slides to the audience so that those who don't want to read the paper can get the gist of it from those slides. Okay, now as Dr. Jalal mentioned, politics is a central dimension of macroeconomic policy, and a lot of policy choices are ultimately rooted in the political domain. That's the established finding in the literature. Now, in the Middle Eastern case, particularly the Arab resource-rich economies, my paper argues that there are two domains that need particular attention: are the fiscal and financial policies. The monetary policy and exchange rate choices are very important, but if you look at the political economy of many of these arrangements, it's really the fiscal and the financial that are really important. The other overriding aspect of political economy of Arab resource-rich economies is that, of course, by virtue of being resource-rich, these economies are hugely shock-prone. And stability is an overriding concern in most of these economies. However, achieving this stability depends more on deep pockets rather than institutional resilience. Now let us begin with fiscal policy. Now, of course, fiscal policy can be construed as an articulation of the political and social bargain that many of the regimes have their populations. This is what political scientists would probably call the nature of the underlying political settlement. So it is very much intertwined with the whole idea of the nature and the function of the state. And that is true, by the way, not just in resource-rich economies, but also countries like Egypt or Lebanon, Syria, a lot of other countries. These issues are hugely connected with the nature and the function of the state. Now, fiscal policy is often used as a means of rent distribution to citizens and elites. We have a lot of patronage commitments, and usually the literature argues that these patronage commitments are used to buy off or purchase the consent of the population. Now that's a slightly simplistic notion. There's a lot more at play there, as I would explain in a little while. But of course, when we think about pro-cyclicality of fiscal policy, which is a pervasive feature of resource-rich economies from Latin America to Africa, the underlying politics of it is very different in the Middle East and North Africa region. And of course, fiscal policy in this region is largely about spending, very little about taxes. So if in state capacity terms, we're not really talking about extractive capacity, the ability to raise taxes. And of course, there's also the sense that huge resource riches provide states a certain autonomy from society. That's what the original version of the rentier state emphasized. But the important point to remember here is that this state autonomy is variable over time. Perhaps there's greater state autonomy in the initial stages of state building, but once certain expenditure commitments were made for subsidies, salaries, whole range of other expenditures, they got locked in over time. Now, if we think about fiscal policy, obviously we would need to start with certain key decision nodes. The first important decision node is how and where do these resource revenues accrue? Are they transparently published and recorded? And a particularly important issue that I would highlight today is the importance of mapping the extra fiscal space. If you look at the graphs, you would see spending on salaries, spending on wages, wages and salaries, subsidies, social protection, capital spending, and then there's an item other, which usually dominates a lot of other items. So there's huge extra fiscal space that remains largely unmapped in Arab RREs. Of course, when it comes to spending, it's not just the level of spending, but also its composition and variability. And variability tells us a great deal about political economy, because in lean years, which items get protected tells us a great deal about the politically binding expenditure commitments. And there's, of course, also the issue of time inconsistency, which I argue is more important in the fiscal domain in this region rather than in the monetary policy domain. Because obviously optimal political responses in periods of low oil prices may not be the same as those during the boom years. And there are issues of long-term fiscal sustainability as well. Okay, let us talk about the composition then and the nature of distributive commitments. The issue in this region is that you have huge distributive commitments to citizens, of course, and then the elites. And what really distinguishes this region from other resource-rich countries is the huge patronage commitments for external constituents as well. So as a net exporter of capital, the Arab resource-rich economies also recycle a lot of wealth in the global system. And the political economy implications of that external recycling is not very well understood. And of course, if you think about any social order, you need to think about resources that are directed towards distribution. Remember, these are not redistributive states. They don't tax and then distribute money. They're largely distributive states. But of course, they're also resources for repression. So defense spending and social services both go along. So we know, for instance, a well-known fact, the region spends huge amounts in salaries, subsidies, health, education, social services, but also extended patronage commitments like housing loans and so on and so forth. In the GCC states, for example, 40 to 60% of government budgets are consumer wages and social service provision. So really startlingly high levels of social service spending. And that, I think, in the political economy literature, this is still a puzzle. It's unresolved. Why Arab resource-rich economies spend far more on social services compared to other regions. There's a new LSE project that's looking at comparisons between Africa and Middle East and North Africa, trying to understand why the region does really well in terms of provisioning, social service provision. Now, of course, there are a number of reasons for this. There's historically embedded political economy of urban provisioning in the Middle East for a very long period of time. It is also connected with the whole idea of state building, because many of these countries, even Qatar and Kuwait, the GCC countries, in order for them to become truly independent sovereign states, spending on schools, hospitals, was an essential part of state building. And of course, in some countries, such as Oman, where there was always a threat of regional rebellions, it was important for them to bring disparate constituencies into the national mainstream. So health, education, social service provision was a very important part of connecting them to the state. And of course, it also links with what Ibrahim mentioned, high resource rents per capita. It's very, very large resource rents. You distribute them to elites. You spend a whole range of things. There's still a lot of pot that is there for you to spend on health and education. But of course, it was also rooted in this whole idea of what we call the dependent middle class constituency. A a lot of rent-seeking intermediaries, and that is kind of intertwined with this whole issue. Infrastructure spending has also been sizable in the region, and that's driven both by the politics of development, because a lot of these regimes would like to be seen as pro-developmental. They would like to diversify through spending on infrastructure. But it is also an important mechanism through rents are distributed to elites. So if you look at projects market in the Middle East, it runs into trillions of dollars, even in the period of low oil prices. And that allows wide distribution of rents to elites, but also to international contractors who can tap into those spoils. But of course, if you look at the global resource curse literature, it talks about the white elephant projects. These are projects which have high, political or social political rates of return, but very limited economic returns. There are obviously questions about, how are projects selected? Are they selected through bidding, or are they actually decided through discretionary or fragmented decision making? But there's a lot in there that one could understand. Again, I'm trying to raise a theme. Each of these topics deserve separate papers, but I'm basically raising the curtain over some of these themes. Now, of course, apart from composition, one needs to think about variability, because it provides us a sense of which expenditures are protected in lean years. Now, of course, the initial fiscal bulge, early on in institutional building, states spent huge amounts on social sectors. And that is explained by middle-class nationalism, particularly in populous Arab states, early investments in human development. But when it comes to the times of adjustment, many of these social service commitments were largely protected. So if you look at wages and subsidies, they're more resilient. Health education spending more resilient. Robust spending on coercive apparatus even during downturns. And I'm kind of following how the arms sales in the region still constitute a huge amount, even in periods of low oil prices. What we do see, however, in more variability is investment spending. So there's something about investment, perhaps, more variable elite commitments. In periods of high oil prices, there's perhaps some kind of an expectation effect which leads to more money being distributed through this. But investment spending is curtailed. And that clearly leads to pro-cyclicality of fiscal policy. Now, an important issue from the perspective of Arab resource-rich economies is the commitment problem in the fiscal policy domain. And the key question that political scientists have usually asked is how to commit rulers to prudent fiscal policy during boom years. Because there's clearly an expectational mismatch. In periods of high oil prices, you tend to consume more and think that those high oil prices are likely to be sustained for a long period of time. In non-Arab RREs, we have political turnover. So greater political turnover. So there's the key commitment issue is how one government may not save enough for the next government. So there are less fiscal incentives. That is not the case in the Middle East, because here we have greater regime durability. The question is more about long-run fiscal sustainability. So, for instance, now there are growing concerns that the fiscal regime is not sustainable. Everybody realizes that in the MENA region. But that there are limited political incentives for any individual ruler to contain spending. And the logic is, one possible logic for this is that even if the prevailing fiscal regimes are unsustainable over the long term, they are sustainable over the lifespan of the individual ruler. And so that issue of fiscal sustainability over the long term is kind of very different in Arab RREs compared to other countries. But there has been some fiscal adjustment too. Saudi Arabia and Algeria are prime examples. In periods of low oil prices in the 1980s, you had some fiscal adjustment. In Algeria's case, this was associated with the declines in public spending in the 1980s, erosion of the social contract. And this is what Ishaq Diwan calls middle-class grievance that came into play. And that burden of this fiscal adjustment fell disproportionately on the middle classes and the poor. And that was certainly important for understanding the age of protest politics around the rise of the FIS in Algeria at that time. Of course, given the primacy of politics, therefore, we could easily understand that the pro-cyclicality of fiscal policy, the importance of political rather than economic smoothing. And that's very much driven by the imperative of regime stability. So subsidies and salaries rise disproportionately with rising oil prices, but are downwardly sticky. Fiscal policy also drives cycles in public and private investment. And we have, of course, growing expenditure commitments during good times, depleting fiscal buffers, which reduces the ability to withstand shocks. So if you want to understand the pro-cyclicality of fiscal policy, you've got to understand the political objective function. Now, in this political objective function, we need to think about the underlying political settlement, the nature of the social contract, the fact that you have very few constituencies with countervailing powers. So macroeconomic policy operates in a relatively unconstrained domain. And of course, the strength of the sovereign relative to the productive sectors of the economy. In this milieu, you have very weak automatic fiscal stabilizers, right? Because, while expenditures respond more quickly to oil prices, revenues aren't. And so you find that asymmetric adjustment of expenditures and revenues. Now, I've got some discussion in the paper also on the comparison of the two oil booms. And you do find significant evidence for social learning. So you have, you could find that in the second oil boom, infrastructure spending, although still very sizable, was more restrained relative to the first oil boom. There was also the more robust savings response in the second oil boom. So you have extensive reliance on stabilization funds, sovereign wealth funds. And of course, the continuing issues of transparency of these sovereign wealth funds. We don't have a very clear sense of what withdrawal rules are. Either they're not specified or not adequately implemented. So what you have in the form of sovereign wealth funds are very interesting savings vehicles, investment vehicles, but are they really a new form or are a new substance is not very clear. And of course, a lot of these sovereign wealth funds are again used to recycle wealth into the global system. So again, some of these are connected also with external patronage commitments. Now this brings me to the final two slides on the fiscal policy dimension, which is really about mapping the de facto fiscal policy regime. Because you have huge size of off-budget spending across most of these countries, very limited knowledge of how the budgetary institutions function, although as a result of this project we have a slightly more nuanced understanding of the form that these institutions take. Quasi-public spending through public sector enterprises, but a whole range of other operations, massive. Large components of spending evade fiscal accounting, and so you have land sales, different kinds of benefits, oil and budgetary supports for neighbors, military spending, military purchases. All these are what are called contingent liabilities in the geopolitical domain. They're largely unmapped, and their consequences for fiscal policy and for political economy are not properly explored. Another important issue you find in these economies is the tight segmentation between the affairs of the Ministry of Oil and the Treasury. Both are governed by very different decision logics. So finances of state petroleum companies, very limited disclosure, probably a great deal of fungibility of resources where resources from one pot are kind of mixed up with others. We don't have a very good sense of what is the number and strength of different veto players in the system, right? And who really has veto power in terms of some of these crucial decisions. And of course, these issues are related with the authority to make fiscal decisions. Okay, so this is just a broad overview of what I think are some of the big issues when it comes to fiscal policy. Another important aspect which has received very limited attention in the literature, not just the global literature on natural resource curse, but also literature on the region, is the role of finance, which I think is hugely important. And therefore, my paper gives a lot more emphasis to that. Now, finance is a very important part of this whole chain because, you're talking about a system where, financial sector provides an important source of rents, unearned income streams generated through, let's say, liberalization of the financial sector, partial liberalization. It sometimes finances oligarchic interests that masquerade as the public sector. This is the case in Algeria. It also provides an important mechanism for diversification. And of course, it can be used to distribute rents to a wider constituency, whether it's housing loans or SME, agriculture, etc. But finance is important because if you control finance, you pretty much control various parts of the markets. And so control of the financial sector is an important element in the distributive state that is governed by a political rather than a productive logic. And here, when we think about the common pathologies in the region, you would find that banks are largely state-owned. I'll provide some more evidence on this. Credit allocation is determined sometimes by is politically controlled, underdeveloped domestic markets. These are some of the issues that I will highlight, and some of them actually have huge relevance for the conduct of monetary policy, because the reliance of monetary policy more on maintaining excess liquidity and reserve requirements is therefore linked with underdeveloped financial markets. Okay. When we think about financial sector development, if you look at crude indicators of finance, this region does fairly well, right? It has deep financial structures, one of the highest deposits to GDP ratios. It extends reasonably high levels of credit, very high levels of financial sector openness. But if you scratch the surface, you actually find significant financial sector fragility, because whilst banks have a large deposit base, it does not translate into credit to the private sector. So financial depth does not translate into financial access. If you look at the loan portfolios, these are one of the most concentrated in the world. So if you look at the ratio of the top 20 exposures to total liquidity is about 182% in GCC. Connected borrowing, again, a key issue. Now, it's important from a macroeconomic standpoint, where are these banks lending? And if you look at the literature, you find, 2 or 3 key areas. I mean, basically real estate, consumer loans, housing, infrastructure projects, public sector corporations. So very limited credit being given to the private sector. The SME sector, hardly 2 to 4% of the total loans. Now, of course, this real estate lending, which is a huge component, has also been a key aspect of Islamic finance, has a distinct political logic, which I would explain in a second. But before I do that, a key issue which relates to the conduct of monetary policy is excess liquidity, because banks tend to keep more liquidity than usually required by the law. Liquid assets in Qatar, for instance, just 50% of total assets, huge. You have high reserve requirements all throughout the region, but those deposits do not convert automatically to more lending. Essentially, it's the hydrocarbon sector that drives the funding base for the banks, rather than the endogenous dynamics of depositing institutions, which means finance, rather than acting as a shock absorber, becomes part of the problem. The other issue relating to the financial sector, which I will just flag but not go into much detail, is of course issues of competition and transparency. When you think about the disclosure of investment policies, crisis management, all those issues are kind of weak areas in the region, but that is also true for many of the other resource-rich economies. More interesting issue is the state ownership of banks, where you do see variation across Arab resource-rich economies. Now, all across the region, you find, high levels of state ownership, but this state's ownership is higher in more populous states. In Bahrain, the top 5 banks are, 75% of total subsector assets. Libya, very similar. Saudi Arabia, very similar. But overall, you would find that in labor-abundant economies, the state ownership of banking sector is higher. And again, I will explain the political logic in a while. Now, what explains this difference is clearly labor and abundant economies have more extensive distributional commitments because they have more, more extensive distributional commitments relative to the available resource base. So one of the ways is to control the banking sector and therefore distribute rents to the favored sectors. And as it happens, many of these populous economies are also have a socialist legacy of state intervention. So part of that explanation also lies in it. But you also have in labor abundant economies high share of non-performing loans, greater informalization of the financial sector. You see that in Libya, you see that in Algeria. And in fact, mild forms of financial repression too, including in Bahrain, where you have very high reserve requirements, which could act as a tax on intermediation capacity. But also in Oman, where you have an implicit capping of the interest rates. Now, when we think about the politics of these arrangements, you could clearly see that there are countries that have made an extensive, put an extensive effort behind financial sector. And you have very large financial sectors in UAE and Bahrain. In Bahrain, wholesale banks' total assets equal 80% of GDP. Similarly high levels in UAE as well. Now, here, the expansion of the financial sector has been used as a principal avenue for diversification, but a politically safe mode of diversification, because it is likely to lead to new forms of capital accumulation that are largely controlled, because the real estate is controlled by the state. So you have the real estate largely controlled by the state in Bahrain, for instance. So all lending that is made to the real estate sector is unlikely to generate new sources of income that could be politically threatening. And so, in a sense, it has been used more as a politically safe avenue. But if you look at the design of the banking sector, you find overlapping structures of ownership and control. State entities are, at least in Algeria, they're the dominant shareholders of the largest banks. In Kuwait, you have government-owned banks that have significant stakes in investment companies, which in turn have stakes in commercial and industrial groups. So there's a lot of related party lending, which is important. I mean, in Saudi Arabia, huge exposure, sometimes up to 50% of banks own funds to a few parties and a few related parties. So banking sector is an important element in this whole political equation. Now that has very important implications, as I'm going to explain, in the monetary policy arena. But before I explain those, let me just recap what is the role of monetary policy. We'll hear more about this during the rest of the day. But by and large, my understanding is that monetary policy has a limited scope and operation in most of these countries, because these are fixed exchange rate regimes with high levels of capital mobility. So you're really running into this impossible trinity in global macroeconomics. There is monetary policy, but it's largely about liquidity management, indirect monetary policy tools such as reserve requirements, repurchasing agreements. So there's some of that. Government deposits, huge component of overall liabilities of central bank balance sheets. The interest rate channel of monetary policy, that the monetary policy would vary interest rates, would shape private sector responses, and therefore shape economy, that doesn't really exist in Arab resource-rich economies. Because monetary policy, yes, it does, it is concerned with employment and inflation stability and others, but monetary policy is not the tool to achieve it. In fact, fiscal policy, is more important there, because, inflationary pressures are contained through subsidies. The main concern, however, is to restrain the impact of external shocks. Two key challenges that emerge in the conduct of monetary policy. One is relatively underdeveloped markets. So you don't have very strong, well-developed markets for government securities, right? Which imposes constraints on liquidity management, reduces the effectiveness of open market operations. You cannot build a benchmark yield curve if you don't have a well-developed secondary market, which effectively reduces the effectiveness of monetary policy instruments. UAE is a good example. It has huge sukuk issuance, but much of this is based on an undiversified investor base and highly concentrated buy and hold portfolio. So literally the banking sector and the public sector enterprises are the captive constituencies for buying government debt. There's very limited competition from institutional investors as well. Now that is easy to understand from a political economy standpoint because the political sovereign is reluctant to concede space to the private sector. If markets are a controlled political domain, then they're primed to produce concentration and fragmentation. So you have independent market linkages that could foster competition and empower private sector, and that is unlikely in the present political climate, which means majority of these trades take place between central banks and banks, but the interbank markets are very weak. So I have about 5 minutes. What I'm going to do is really put out the agenda from the rest of the slides, and hopefully we can take those more questions during the break. The second challenge in the conduct of monetary policy is the low levels of central bank independence. We will talk more about it during the rest of the day, but essentially, we don't have clearly stated rules and objectives that could act as commitment devices. It's an unpredictable domain. You don't have an independent constituency that could demand and receive policy signals and that have that interaction. That interaction is missing. So typically, all these different markets are controlled separately. If you leave it to the market devices, then it creates an uncertain domain in the present climate. Of course, there is greater de facto independence of Algerian central bank, and again, politics is key because if it were not the crisis in the 1980s that forced Algeria to go to the IMF and concede space, it would have been difficult to win that kind of independence. Now, finally, just a few minutes on the exchange rate choice. Most of these countries have fixed exchange rate regimes. Of course, Kuwait has a basket, and you have managed float in Algeria and Libya. But it's really the choice, as the old adage suggests, between fixed and flexible regime is really between good and bad macro policy. Much of the global literature that emphasizes structural economic and political factors that predict why some countries have fixed exchange rate regime are not relevant in the Middle East. A few other issues, however, are very important. One, of course, is sustainability. The fact that most of these economies, particularly in the GCC, have huge reserves means fixed exchange rate regimes are more sustainable. So it's really a question of sustainability first. Second, it's a very cheap instrument for credibility, because if you build credibility through markets, you have to be consistent, you have to be predictable, you have to have frequent, consistent interactions. Having a fixed exchange rate regime, very easy, build credibility through that. Of course, economic structure is important because you have a dominance of the public sector. Export sector is hardly present there. I mean, you don't have an independent constituency that would say, that would have a stake in the exchange rate regime. High degree of import dependence, because throughout the region, if you talk about the merchant classes, they're largely tied with import agencies, licensed distribution of products, huge import interest. So think about tradables, take away the export sector is really the import sector, which has a huge stake. Price stability is important, but as some of the people have suggested, inflationary pressures from food imports are typically controlled through subsidies. So price stability perhaps is not the core reason behind this choice. But of course, there's also something about capital mobility, because as I mentioned early on in the presentation, most of the Arab RREs are net exporters of capital. So liberalized capital accounts make economic sense, of course, because they drain liquidity from the system, prevent Dutch disease effects, you have limited absorptive capacity at home, and so you spend more. But there's a complementary political logic for a liberalized capital regime. One is that there's huge external recycling of rents, which buys geostrategic leverage for regimes. Trillions of dollars are invested in buying companies, US Treasury bills, charity contributions, infrastructure projects, arms purchases, fiscal support for neighboring governments. These are contingent, geopolitical contingent liabilities, but they're also by binding political commitments for regime stability. And this is very different from what Carlsberg talked about capital mobility, that when a country has greater capital mobility, democracy is less threatening to the elites. But the equation is very different in the Middle East, where actually this external recycling is very much part of the domestic political equilibrium and hasn't really been explored properly in the global literature. I'll end by emphasizing that, of course, we've talked about fiscal, monetary, exchange rate policies, financial policies, but a very crucial part of the future agenda should be to look at the general equilibrium effects. How these various domains are interconnected, because you're talking about linkages, complementarity, spillovers. Of course, when you have state ownership of banks, you have underdeveloped debt markets, then you have fewer instruments available to manage liquidity and shocks. So inefficiency in one domain travels to other domains. If Algeria has pervasive exchange rate controls, it undermines the development of secondary debt markets, which in turn has huge implications for other domains. So one need to look at linkages between these various policies, and when you truly estimate the cost of inefficiency in an individual market, you really have to think about linkages with the rest of the economy. I think I will kind of leave it at that. Overall, I think my sense is that fiscal and financial sectors are more important for us to look at, and that if we look at rent recycling, it's not just domestic rent recycling, it's also external rent recycling, which, although politically sensitive, I think as scholars we should look at its implications. It's not just about domestic, it's the globe, it's the total picture. I think the quasi-fiscal sector activity and the de facto fiscal policy regime is largely unmapped, needs to be looked at, and need to think about a coherent macroeconomic policy framework which takes a big picture view of the entire economy and identifies how different sets of the macroeconomic picture get together. And I'll finish at that.